more so a positive highlight, is hyperliquid in the event, no downtime, withdrawals still functioned. The community pool, HLP, did well and it did its job.
I think people learned about ADL for the first time on hyperliquid. That was quite funny to watch all these like, why is my position closed?
Won't be that big compared to what we have previously seen in 2022, 2021, because there was not a systemical failure compared to, for example, UST.
From a market structure perspective, probably the most disgusting liquidation cascade in the history of the entire crypto industry. And I'd be very surprised if that didn't lead to some major blowups that will unfold.
Operating as a public company, there are definitely restrictions and things that we can or can't do.
GM, everybody. Welcome back to the Odyssey Roundtable. I'm calling in today live from DAS London. I think, Owner, you're in Berlin. Yuri, you're in Lisbon. JR, our special guest today, I guess you're back in the US. And we'll recap all the happenings of Friday and the fallout of that. We'll dive a little deeper into JR's BNB treasury, which is very fitting with the current BNB change season. And maybe I'll be able to give one or two initial takeaways from DAS London. But happy to have you on, JR. Thanks for joining. And how's everybody doing? How did you guys weather the storm on Friday and Saturday?
Good. Hey, thanks for having me. The storm Friday was definitely a massive vol spike. It's a long-term bullish view is what I have. And if we get some kind of volatility in the interim as we continue our climb, that's just part of it. How about you guys?
Resonates with me pretty much. So I actually didn't experience it that harshly compared to what you have seen on crypto Twitter, mainly because I'm not too deep into the alt trenches right now, just Bitcoin and ETH and Sol a little bit. So it was like fairly okay. And to be honest, nothing much changed. I just saw that a lot of leverage was in the market with all of the perps. So, I mean, it was kind of expected to see things blow up if some resistance comes from the traditional market. So I found it okay and optimistic. I mean, we have seen some relief already. So nothing major, right? What about you, Ona?
Yeah, I also don't have any perps or leveraged exposure. I actually tried to buy during the dip a little bit. Nothing executed. Like all transactions failed. Crazy. How do you say? Like it was just like a bottleneck. Like nothing worked. And then after a few moments, everything was recovered already. But I don't really touch perps, to be honest. That's way too scary for me, and I don't have any edge there. So, but the thing I tell myself is, every time you look at the cycle progression, you have like 2-3 of these days every cycle. And all you need to do is like have enough stables to act on these situations as opposed to like trading random assets back and forth. But it's always the same. But all good on my side.
Yeah, I got less affected than I would have expected. One of the first events where I didn't get hit disproportionately hard. I still remember back in the Luna UST days, I received my salary in UST like 2 days before the collapse. And of course, I was too stupid to cash it out beforehand. So that hurt quite a bit as a student back then. And FTX was my main trading venue. But this time I was surprisingly stabled up because I was reshuffling a few wallets. Also didn't have any perps positions on at that very point in time, even though I am farming some of the perp DEXs right now, mostly Pacifica, Extended, and Hyperliquid, obviously. I'm not on Aster or Lighter. I never farmed Aster, and I think for Lighter, I think by now I wouldn't say it's too late in the sense that you cannot get an airdrop at any time anymore, but you have to push a lot of volume through it. But the LLP, the counterparty vault on Lighter, actually is looking pretty decent. I think up to the crash, it had an APR of almost 50% because a bunch of people are willing to execute, let's say, rather suboptimal perp strategies in order to just drive volume and get the airdrop. And on the note of the counterparty vaults, the HLP vault was eating insanely well throughout this crash. I think it made like a double-digit percentage of its all-time P&L just throughout these 2 to 3 hours. So I think just recapping and studying the event that happened on Friday is going to be quite important for the industry going forward, because a rather banal TradFi news announcement leading to such a cascade is pretty insane. And I think nobody in the industry expected that. Some like DeFi cross-collateralization bottleneck or whatever would have happened, or just another stablecoin DPEG, blah, blah. Like that could have probably been like somewhat expected. Some people were concerned about that, or a large DAT blowing up. But yeah, I mean, by now we have been getting kind of used to all the trade wars going on. And in comparison to the tariff announcement that we've seen in April and the months after that, that wasn't really that big. And the existing trade conflict between China and US was very well established at the point in time that news announcements got broadcasted. So yeah, it's going to be interesting going forward how this whole thing unfolds. At DAS London earlier, there was a debate between Josip from Dragonfly and Jordi from Selene, talking about Ethena as kind of a systemic risk, and like these synthetic stables in general, sort of bringing us into the same situation as we have seen with Luna back in the 2022 days. Obviously not in terms of the same underlying mechanisms, because Luna and UST were not collateralized and Ethena are, but just the fact that people are treating Ethena as a risk-free stable could lead to some systemic risks down the road. Personally, I think the truth is somewhere in the middle there. I mean, of course, the Jordi and Selene, they have a point that we cannot assume these things to be on the same risk category as, like, let's say, Circle or Tether. But on the other hand, I don't think that there's any underlying systemic risk that would lead to a full-fledged collapse, because at the end of the day, most of these things are still collateralized, if not even over-collateralized. But yeah, maybe JR, I mean, out of all 4 of us, you're probably the one managing the book from a more professional standpoint. How did you guys weather the storm on Friday? And like, how can the audience think about how people like you who are doing this professionally are reacting to a situation like that?
Great question. Let me give you a little background on me, and then that can kind of paint the color for my background and kind of exposure with kind of institutional grade digital asset management. Background was graduating with a computer science degree out of Texas A&M about 2016, 2017, and then joining the Air Force active duty as a research analyst directly following that. I served there for about 5 years active duty, and then kind of at the tail end of that, started to kind of notice the second wave of crypto kind of come onto the scene in the form of decentralized finance. I took kind of the skill set that I had been taught with my undergrad and kind of applied research and applied to the on-chain markets, on-chain financial markets, and was able to see there were some kind of pretty big inefficiencies going on. So built some models, simulations, called up one of my old business partners and said, hey, there's a big opportunity here. Let's start a hedge fund. It ended up being the second hedge fund that I started. The first one was my last year in college. But this one focused more so specifically on what we're talking about with decentralized finance and kind of extracting inefficiencies. That was called On-Chain Alpha, and we ended up opening that, running that for about a year, and then we ran into some other folks at Coral DeFi. Just coincidentally, we found we were doing very similar strategies, and it kind of made sense to combine forces in a way that we could kind of perform those strategies at larger scale. So Josh and I came on as partners to Coral DeFi. We ended up growing that to hundreds of millions of dollars of assets under management. And then just in the past year, we ended up selling that to DNA, which is a product of Scott Walker and Brock Pierce. And now it's a multi-divisions where they have market making, asset management, events, and so on. After we ended up selling that, we ended up helping out for a little more than a year, and kind of because in a consulting capacity for the asset management side of the book. And then just recently, we partner and I, Josh, my long-term partner, Josh, we ended up kind of taking a step back, analyzing the space, and seeing that the space is where's the most optimal space to kind of be. And then looking at Binance with its ecosystem and its growth, and we kind of view digital asset treasuries as the next really big innovation in the crypto kind of wave, where you're getting decentralized finance, but also the benefits of traditional finance. And if you're combining the two, there's kind of a lot of growth that can be had there. So Josh and I and another partner, Patrick, a Horseman, decided to get together, raise for a BNB DAT for a public company, which is Applied DNA Sciences. And we just recently, it's a NASDAQ traded company. We recently just changed the symbol to BNBX and announced our closing of our first closing. And then as far as how we were able to kind of fare in the Friday weathering, we saw that as an incredible buying opportunity. So my longtime business partner Josh and I were on the phone at the time, and we were talking. We just looked at the market and we saw, wow, one of our triggers went off. There's extended leverage being or extended deleveraging that's happening in the market. We looked over to the computer and saw some quite volatile price history. We ended up opening up our account. Ended up purchasing BNB at a massive discount. Ended up getting some fills at about $900. So. Overall, we had a pretty good experience with it, and I know the company fared really well, being able to execute some of our long-term kind of BNB holds at that price point. So that's what we're kind of continuing to see is BNB kind of bounce back with extremely strong price action, and one of the stronger of the directionally exposed assets that kind of took the scene following this. I think I haven't checked price today, but I think as of late yesterday, we were almost at new all-time highs for BNB.
Yeah, we briefly
to
hit
where it was trading.
BNB all-time highs a few hours ago. So that's an
Yeah,
insane recovery given what followed on Friday.
Yeah, I mean that's our view, and it's just really nice to see the thesis kind of playing out. Where if you're building a digital asset treasury, one with a productive asset, meaning you can generate yield with it, and it's a fundamentally extremely strong asset to hold, just by the nature of having the largest crypto business in the world, with 40% of total addressable market space and perps volume and spot volume. It's just incredible to see that kind of playing out. You've got the juggernaut in the crypto space backing a token and driving its value to the token and token holders that are staking it, such that you have an opportunity to be in that space on kind of a global scene. And this is additionally one of those times where never before has there been access to equity-like exposure on a global scale with a touch of a button. So again, we just kind of see this as a little bit of an access play, where people in the U.S. Trying to get exposure to BNB, unless there's kind of a sophisticated user and institutional grade participant, it's kind of difficult. And so that's kind of one of the problems we want to solve. So I can turn it back to you guys.
Nice. Do you guys think that there's going to be any second and third order consequences of the fallout on Friday? Because if we look at it from a fundamental perspective, nothing has really changed. I mean, crypto in theory shouldn't be affected at all by all the tariff stuff. Of course it is, because it's a risk asset and depending on liquidity flows, yada yada. I mean, we've had all of these debates before in April. I think from a fundamental perspective, from what we've seen in the markets being announced over the past couple of weeks, also anecdotally from what I've seen and talked about at Token 2049 1.5 weeks ago, I'm looking on the industry from a very optimistic perspective right now. I think many of the goals and integrations we've wanted to achieve on the regulatory side, on the application side, fintech side, banking side, but we have only dreamed of in 2021 are now becoming reality and pretty much are being announced every week to every couple of days. On the other hand, we've seen from a market structure perspective, probably the most disgusting liquidation cascade in the history of the entire crypto industry. And I'd personally be very surprised if that didn't lead to some major blowups that will unfold and potentially have to unwind over the next couple of days and weeks. So yeah, curious to hear your guys' perspective if that is going to be a one-off event and we've kind of cleared out everything that was to be cleared out, or if there's going to be some cascading downwards further in some other second and third order manner.
I mean, there
Yeah.
have been smaller consequences already. I've heard from this one Ukrainian fund that completely imploded.
Oh, the guy who killed himself?
Yeah, he committed suicide, so I think that's already quite a very tragic consequence from that. Maybe a few more further down the road, but I think it won't be that big compared to what we have previously seen in 2022, 2021, because there was not a systemical failure compared to, for example, UST, etc. It was, I believe, just a bunch of leverage used in the market, and yeah, that's always the consequence when there's a lot of leverage in the market. Prices go down, it hits twice as hard. And to be honest, I was also very surprised, and maybe that's also a question that I have for you guys. I was very surprised how surprised crypto Twitter was. I was like, guys, I mean, there was like so much money in the market, so much leverage. Now the market went down. Why are we all surprised that the crash was like even harder? I mean, if you party hard, the hangover is probably even harder the next morning. So I don't know, were you also a little bit surprised how everyone was surprised that leverage can end badly?
Well, I mean, there was a bunch of open interest in the market, but if you looked at funding rates and all the sentiment indicators, we were very, very far from delusionally bullish territory here. Like, this was not foreseeable by any means, I'd argue. Like, and if we would have had a normal flush just to clear out open interests, it would not have escalated as badly as this has. Because, I mean, you have to consider the fact that on many centralized exchanges, even the big ones like Binance, all coins wick down 80%, 90%. I think Atom wick down to like the 10th of a cent on Binance temporarily. Like, this is not how a normal deleveraging unfolds. I mean, we've seen these things a bunch of times. We've seen them, I think, even in this bull market. I think there was one event in like late spring, early summer 2024. Then there was one in August 2024. You've seen it during all the initial tariff scares. So yeah, that's not how these things unfold. And I think it's very clear that some large entity must have blown up because the order books were completely empty. That was the precondition that even led to these extreme wicks downwards, which are absolutely nothing in the ordinary and nothing that we should have expected at this moment and this stage of the market. But yeah, curious to hear different opinions on that.
You guys go first because I have a different opinion, but yeah.
I spoke to a few market makers because there were rumors that some market makers got liquidated and which led to this cascade. So far, I can't confirm that. I think market makers are fine, but there is some, I mean, JR, you mentioned some deleveraging going on. I think people learned about ADL for the first time on Hyperliquid. That was quite funny to watch all these, like, why is my position closed? But also, like, market makers, I think, do a lot of, like, live rebalancing on days like this. So it's not really a surprise in my mind that order books were empty. I think it's just like tools that get out of the books to see what happens and then, like, slowly rebalance the positions. But yeah, super curious to hear also what you think.
Yeah, to the original question of like, what are the kind of the first and second order effects that'll happen and kind of stem from this? And I think that's a great question that kind of speaks to kind of the ethos and kind of the heart of DeFi, like at its core. Because the way I view it is this is the hardening ground for anti-fragile systems and kind of run in like a production capacity with, not good, not bad, but it allows, everyday people to be kind of on the frontier of finance and tech and to kind of see the theme of this. I mean, look at what we saw with DeFi Summer, right? You had the initial waves of automated market makers come out, and you had the simple Y equals XK formula where it's a simple two-pool Uniswap. And since then, we've had V3, we've had V4, now we have CLOB models on perps DEXs. We've had just the proliferation of different versions and forms of it. And now we're at a point where I think you get kind of the best of both worlds with what PancakeSwap has implemented, which is essentially a Uniswap V3 or V4 model with a gauge for people specifically at the actual tick of where it's trading. And that allows for the ease of, the casual DeFi user that just wants to put some money to work. He goes and sets a range, and then he gets a fee on trading volume. But if you have the more sophisticated user that wants, a bot to set limit orders resting or wherever they may be, they can maybe go to a club, and both of them are going to get compensated. And the market, based on volume, will change that. Following a DeFi summer, we saw, there's a bunch of these, but we saw kind of the GMX forks where you had basically baskets of digital assets with stable coins. And because it was just such a massive pool, it drove rapid volume through it, which gave it that those good fundamentals to kind of value it against GMX, which was kind of the OG and established itself as kind of the blue chip in the space for performing that. Then you had the Ohm saga, where everyone was starting an Ohm clone. These are kind of the games that you just see kind of played out in DeFi, where it's on the frontier. And as time goes, you tend to see kind of the best surviving, because how many of the Ohm forks, I think at one time I had an Excel sheet with, I think, 50 different Ohm forks. And to this day, I think there's, maybe a handful left, with Ohm kind of leading the charge with assets under management and kind of a strong team for it. Right now, I think we're in the middle of the PerpsDex saga, where you had a bunch of PerpsDexs come out, some from the GMX clone era, and then now I think we've seen kind of more of a shift to the CLOB model. And I think we're in that stage where the first and second order effects are happening. We're seeing them in real time. And the latest version, the latest thing that kind of is that DeFi is focusing in on is CLOB models, PerpsDexs. Like how do the exchanges essentially handle auto deleveraging in the case of a open interest or a deleveraging event, which we saw a great one on Friday, I think, by fundamental metrics was kind of on par with the UST kind of downfall, the Luna UST. And I think a lot of the exchanges or PerpsDexs weren't quite prepared. I think Hyperliquid fared extremely well. Some of the others had some outage time, and I think some of the others put up some losses for kind of their community pool. But we're in that space where kind of the pitcher's throwing the hard fastballs, and the guys that are ready to bat are batting it out of the park. I mean, Hyperliquid did extremely well. Their HLP pool, I think, pulled 10% in a day, made 40 million just on the event itself. No downtime. There was some forced auto deleveraging, and some of the other ones I can't speak to as doing quite as well, but still competitors in the space, and they'll probably take this as an opportunity to learn from it, grow from it, and become better for it. So, as a whole, I'm excited to see, the continued iterations that these tough environments make for DeFi at large. So,
Was there any, maybe specifically for the PerpDexes, is there any project that you think handled the whole situation rather poorly and is going to suffer from that in the mid to long run in terms of user retention and their potential valuation once their airdrop goes live?
I I don't want to call specifically out any of them, but I think it's quite apparent. Some of them had downtime. Some of them took 5-6 hours plus for a withdrawal that was typically done instantaneously. And I think that's just one of the issues that has to come from this is a learning opportunity. And I think really the only one that I would highlight, and it's more so a positive highlight, is Hyperliquid in the event. No downtime, withdrawal still functioned. The community pool HLP did well, and it did its job. It allowed people to kind of in a passive way, in a I won't say carefree, but in a passive way, allocate money to a strategy that should do well in most market environments, and return a yield. And so I'd probably highlight Hyperliquid for handling that. And there's probably other PerpsDexes maybe I'm not aware of that probably did well as well, but I just wasn't looking at them directly.
Maybe Owner and JR, geared towards both of you. How do you think this is going to affect both investor sentiment and willingness to allocate into the industry going forward? Maybe Owner, you can answer that specifically for the Solana tranches and memes? Like, was that kind of the final confirmation that people are moving away from stuff that is like blanket speculation and blanket long exposure, and or if at all, if they want to allocate more geared towards these fundamental plays that they can at least attempt to value? And do you think that a lot of the trench people actually blew up? And maybe JR, you can answer that more for the institutional side. I think right before that, we've had as much TradFi capital appetite for crypto as we've never had before. And how do you think the events from Friday are going to affect these trends going forward?
Yeah.
So I do not think that there is a specific relation with regards to the type of asset. I think what's more important with regards to the event is actually the logistics of which pairs exist in the market in the first place, and then who market makes them, right? Just to give you an example, there are big memes which are on all centralized exchanges, which have big market makers market making for them, and then there's small memes. And obviously the big memes, to some extent, were hit harder because they're just like more connected to the overall crypto market and market making. When it comes to small memes, I saw twofold. I saw like assets which weren't affected at all. And then I saw assets which just because of like fear and FUD dropped 60 to 80% and then bounced another like, I don't know, 50% right after. So most are still down. But in that sense, like, to answer your question, does this affect investor sentiment with regards to high risk meme assets? I'm not sure. I don't think so. I think memes, didn't change because of the flush, and they weren't different before. So if an investor has appetite for some like purely community and narrative based token without any utility, without any tech, I think they will still have their place. And I think that deleveraging was a net positive. So in that sense, I think most trenchers did fairly okay.
I would kind of echo that sentiment as well. Most of the typical kind of trench warrior that I hear and kind of the user experience that I kind of see from that is they're normally looking kind of at the micro caps, waiting for the new kind of pump fund meme to kind of launch, and then they're putting kind of a small amount of ammo, or in some cases a large amount of ammo from kind of their portfolio into that, and kind of hoping for the next kind of climb on that. I think there's even the sophisticated user as well, kind of in the trench space, is using more kind of bots, kind of taking a systematic approach. And I think that just because of the nature of kind of those extremely small caps, you don't really see the addition of leverage being applied to that situation. So it's more kind of spot market behavior, and then the most exposure that they would have had, generally speaking, to that market would be kind of the pairing asset. In a lot of cases, it's Solana. So some meme coin again paired against Solana, and we saw Solana, I think, just up memory here, 200 and something dropped down like 130, 140 or so, which is quite an impressive drop. But has since recovered for the most part, not quite to all-time highs or anything, but has recovered a good part. And I think this will kind of change their behavior, or kind of modify or bring them back to more fundamentals? Maybe some, but I think generally speaking, most people enter the space with such kind of an open mind of looking at, hey, this is where I see alpha, or this is where I see opportunity, and then they just go kind of down the rabbit hole, which, by the way, is infinite, because there's no, anyone who has a computer and an internet connection can build or develop. I think DeFi has become the Lego playground where everyone, if they can dream it, they can build it. That kind of mentality allows for all these new niches that we never even knew existed, are allowed to be built and financialized at the same time. So the meme warriors will probably keep doing that. The guys that are kind of focused on fundamentals will keep doing that. And then the market structure guys will kind of, I think, we're taught kind of the hardest lesson, that they need to be monitor their leverage. They need to understand the auto deleveraging that happens on their exchange or their trading venue, and size appropriately. I think kind of one of the takeaways that I've seen is trading Bitcoin on 10x leverage is safer than trading most alts on 2 or 3x leverage from a just a historical look at what we saw with Friday. And that's kind of a big kind of takeaway to walk away from this, at least, from what I'm saying. Whereas, just intuition, you would think, maybe alts could have a little bit more leverage and still be safer, but not from what we saw on Friday.
Yeah, I think Friday also exposed that there is not really a default low risk strategy in crypto and in DeFi. Like if you're involved with some sort of leverage, also if it's about levering up yield bearing stable coins against other ones, as long as you're not kind of, dealing with hard coded oracles, which just hard code these things at the given exchange rate or at 1-to-1 to other stable coins, you can be affected by DPEX. I mean, this could definitely lead to some contagion risks down the road, but from what I've heard in some discussions here at DAS is that kind of everybody right now who is on the DeFi side of things active in the market is very happy that even centralized exchanges are dealing with hard-coded oracles right now, which just kind of guarantee a peg, which in essence is an honest peg because these things are collateralized, but still, just from a liquidity and market structure perspective, if we see events like Friday happening, you could briefly depack these assets just by a matter of liquidity, not necessarily by means of under collateralization. So yeah, I think that's going to be interesting to see unfold and develop in the future, because if we are really onboarding trillions of dollars of TradFi capital, I'm curious to see how they will react and what kind of expectations they will bring to the structure and unwinding of these markets if we see events like these again. Maybe Yuri, from a validator's perspective, did you guys have any reactions on Friday's events, maybe from your large stakers, or did you see anything abnormal in the validator market following Friday, or is it business as usual and everybody is carrying on?
Business as usual, to be honest. It was like something happened in the US. But also, to be fair, again, I mean, we have seen a lot of activity in the perps market, but most of, our clients stake their assets with us, so there is not much withdrawing going on. There was like swift recovery. So yeah, we went back to business, and the other thing was like also we were like more exposed to Sui and Solana, and those did like relatively stable compared to the others, and also recovered quite fastly. So from that perspective, nothing was abnormal. And also to add to what the others already said, like I don't think there will be like much kind of a change. I mean, I completely agree with. I think it just strengthens the position of Bitcoin in the market, and in the belief that it is de facto the safe harbor if we compare it to the other alts, except the stablecoin market, of course. But yeah, besides that, there was not much activity going on our side, to be very honest.
No, I agree. I mean, also, if you just look at the bottom of the wicks of, let's say, BTC, ETH, but everything that comes with Solana, and after that, that is lower in market cap. I mean, you really saw a disproportionate difference there on how liquid the order books actually were, and how, deep down we went. Maybe to pivot topics a little bit, because I think we've covered the aftermath of Friday very well so far. We could dive deeper into BNBX. Maybe JR, I think
Sure.
it's great having somebody on who has been at the forefront of the creation of a DAT. Could you maybe walk us through from the early stages? How does an idea like that come to be? How do you pick the existing company? What does the takeover process look like? Is there usually synergies between these companies' existing business models and the asset acquisition for the treasury? How are funds raised? Who are usually the LPs into these DATs? And what are your plans on doing with all the accumulated BNB afterwards?
Yeah, absolutely. And great question. That opens a flurry of the last couple months that I've spent kind of just in the trenches of working with the raising and with the team for kind of pulling the deal together. There's a lot of moving parts, and a lot of moving pieces from different kind of people in areas. But To talk kind of specifically on applied DNA sciences and what we did to get that set up was, um, it's essentially you have the public company, you have the bankers, and then you have your team that kind of comes in. Most of them are, well, there's a bunch of different structurings. The structuring that we did was called a PIPE, which is a public investment into a public entity. Or I'm sorry, private investment into a public entity, and that involves raising capital. And then once you have the capital, working with a bank to put the funds in escrow, subject to terms that you negotiate with the public company. And uh, we ended up doing an at market pipe deal, raising significant capital for it. And then um, once the assets are in there and the deal closes, then you have the ability to kind of execute on the strategy that you pitched investors on, that you talked with people, and that you kind of shared for making use of the productive assets. And one of the things that I think kind of distinguish us here at Build and Build is the ability to do this with an extremely fundamentally strong asset and have it be productive. I think with as we've seen, and Bitcoin is an incredibly strong asset, but it's not necessarily productive. And it's extremely difficult to be made to use, although it can be in DeFi. But at the scale that digital asset treasury companies work at, it's almost prohibitive unless you're just kind of selling time decay on it through options or sophisticated strategies like that. And then that kind of leaves kind of the next big hitters, which are Ethereum and BNB, both of which are productive. But the way that we kind of saw kind of the digital asset space kind of emerging was the proliferation and kind of understanding of what Ethereum is on kind of a global set was extremely well known. And I think it has kind of market adoption in the Western world, and then East Asia area. Whereas when you look at Binance and BNB, a little bit of a different story is kind of told. In kind of East Asia, BNB is a household name. Everyone knows Binance. Everyone has a Binance account. However, when you come over to the US or kind of the Western world, you see a different story kind of being told where the previous administration was extremely negative towards crypto. And I know this personally. Operation Choke Point, where they would go out and kind of debank, fintech companies that were operating or even touching crypto tangentially, they would debank you. They pull your bank up. Each hedge fund that I was a part of or had as a client or working with, every one of them got debanked. And so they had to go scramble to find a new bank while still running their business, which is not a fun place to be in if you're a business owner. So the previous administration was unfavorable to kind of the Binance ecosystem. And so kind of looking at the fundamentals and kind of the macro perspective of you have this absolute juggernaut, which is Binance, the exchange, and then you have the BNB ecosystem. If you look at them, pull up DeFi Llama and look at them over the term of past 5 or 6 years, you'll see kind of a steady growth of market share. And then as the previous administration was kind of unfavorable, you see the market share kind of hold its own, but without the presence of growing in kind of without the efforts of growing in kind of the Western world, because they weren't welcome there. And despite the negative kind of sentiment and pressures put on them, they were still able to hold market share, and maintain at even a multiple above kind of second and third place for market share in the space, which is Bybit and OKX. With that kind of setting the backdrop, we think with the new administration being more kind of favorable to crypto, this gives the opportunity for BNB to kind of proliferate and come into the US markets, which we think has the most asymmetric return. Where globally, if you look at kind of dollar flows and capital allocations, at least from the US, that's a substantial market. And if you have a crypto asset, one, that's productive, two, that's extremely large, developed, mature, can put the productive asset to work, and you see that now entering the Western world or the space where there's a lot of capital flows, we just view that extremely asymmetrically. And so it was kind of a no-brainer where when we were kind of looking at what makes and sets up the best digital asset treasury play, it's BNB, it's focusing on the Binance ecosystem, and it's an accumulation of the underlying asset, which is an incredibly fundamentally strong asset, which over the next 5 years, we conservatively expect a 3x on price movements. And in the in the meantime, what would you do with the kind of the productive asset and some of our strategies? We have We have a core set of strategies that we'll employ, but one of which I'll share just kind of here publicly. It's well known, but it's launch pool. That's essentially taking BNB, staking it to the Binance exchange, and earning a small allocation of future projects that want to launch and have their token generation event. This has been incredible for BNB, token price and fundamental value strength, just as an overall metric. And I think part of that is it gives some sense of evaluation to the BNB token, where a 3-year look back historically on launch pool and how that's performed has been from about 8 to 14%, depending on when you sold the tokens that you were given. And if you want to compare owning an asset and earning a yield on it with, our T-bills of, right around 4%, this is a, 2.5x increase on the rate that you could expect. And then holding an asset that is fundamentally pure and strong based on the growth of Binance is just a no-brainer. That's how we
I have
view
a ton
the
of
space.
questions.
Yeah, that's how we view the
So
space.
sorry.
Jump in. Yeah.
This is so interesting. So I have a lot of questions, but let me structure my thoughts for 1 second. So going reverse. So I think everything like post you have a DAT company and you start deploying capital and what's your thesis and what areas you invest in make perfect sense to me. What is a little bit unclear to me, and I would love to know that, is logistically, like, this is almost like a CTO of a company, right? Like you gather some amount of capital and then
For
you
context,
don't.
for the non-trencher, CTO is a community takeover.
Yeah, this is almost
So
like
not a chief technical officer.
Investor takeover type. So could you maybe explain a little bit of the process? So let's say I identify a company that I see fit and I raise $50, $100 million, whatever. If you do this PIPE type of investment, does this capital go directly into the company, which you can then take to invest into the assets you're planning to invest in? Or like, how does the value flow here, if my question makes sense?
Yeah, absolutely. So generally, when you're kind of shopping around for a public company, which typically you refer to as the target, when there's not NDA signed and you're in talks with a bunch of them. Ours is launched, so I can refer to them. It's Applied DNA, and our trading symbol is BNBX, which just recently changed. So it's BNBX now. You have talks with them and the existing kind of exec team. You form conversations and what you ask them what is their plan? What are they going to do? Are they on a path to bankruptcy? Are they on a path to something that hasn't been kind of discovered yet, that all of a sudden will kind of pull them out of the spot that they're in? Generally speaking, companies that are trading at kind of the lower market caps are there for a reason, and it's more so because they had a good idea, or they had something that they were working on that had a great valuation at one point, but for whatever reason, the market had decided that the valuation of that company has deteriorated and it has structurally come down in price. And when they come down to the sub 10 million market cap size, at that point they're kind of questioning, does it make sense to be a public company? Does it make sense for this product or what the service that we're offering to keep pursuing this path? And so generally they're open to conversations of investors or bankers coming in and talking with them and saying, hey, I've got this idea, let's turn this company around. Here are some pivots that we can do to kind of make that happen. And that's what happened. We got connected through our banker, which we used Lucid Banking. And we had a great experience with them. They came in, they connected us. We got to talks with the executive team. We found out that they were looking for kind of a pivot in the space. They were interested in it. We wanted to work with a public company to kind of have access to the liquidity rails that a public company offers. And so we got formed up. We talked. We found out it was a good fit. We raised the capital, and we found terms that made sense for our investors and the existing exec team. And upon deal closing, we facilitated, the money moves from the escrow account at the bank, gets put into the target public company. And then once it's there, we additionally had a consulting agreement, which was part of the terms, where me, Patrick Horseman, and Josh Kruger were able to come in and offer strategic consulting and advisory services to kind of manage the digital asset treasury companies. We're kind of we're explicitly hands-on with what we're doing with the public company, and have a good working relationship with them. So yeah, it's essentially taking the skill sets that I've had from managing hundreds of millions of dollars from the hedge fund space and applying it directly into kind of the public company perspective.
And then the money that you use to buy BNB with, is that mainly the money that's been in the company before? Is that the money that you raise, so to speak, minus some overhead for buyouts? How can I think of
Absolutely.
that?
And let me take another step back. There's a bunch of different ways to do DAT, Digital Asset Treasury Company, some of which involve immediately coming in and taking over the company and kind of kicking out or firing kind of the existing team. That's not the strategy we ended up doing. Those require oftentimes a lot of wait time. They can be kind of a little more frustrating situations with conversations and stuff. And I think some of the deals that ended up doing the digital asset treasury companies kind of from the get go still have some money that's in escrow, waiting on some post closing conditions and stuff. We ended up taking a different approach just structurally. When you do a PIPE, which is private investment in a public company, public entity, at market, you can come in and then one of the kind of caveats is you can't take direct control of the company as a part of that. That's the approach that we used, mostly because we viewed kind of the market as like a timing. That one of the biggest things was timing for us. And if we're able to come in immediately, work with the existing executive team that's there, and they are already on board and wanting to do a pivot, it makes sense to say, hey, you're part of the, let's form a team together, let's work together. Let's continue some of the stuff that you're working on. Let's try to have it kind of scaled down to some degree to where we can focus and kind of put the proceeds of the company onto other aspects, which in our case we think the digital asset treasury strategy is the one that makes the most sense. So it's a flow of funds from investors plus existing capital that the public company has, and then once it's all together, it's all one entity. Everyone's working together. Everyone's rowing in the same direction.
Okay, one last question. Super interesting insight. Thank you very much for sharing all this. If you look at the BNBX chart, mainly obviously the historic chart, it looks crazy to me. It looks like it was valued at like 100 million at some point, and then it dropped all the way to $2.50, if I'm not mistaken. Do you have any insights on what happened there? Was there like a capital increase or any insights on?
Yeah, so
It just looks unusual to me. Yeah.
Yeah, I can talk to that. That's typically the chart you're going to see for biotech stocks, because similar to kind of the meme space and the trench warriors, where you get high volatility. I guess kind of the TradFi equivalent of that is kind of biotech stocks, where they previously come out to the market with these incredibly high valuations that are mostly based upon kind of FDA approvals and stage 1, stage 2 testing of drugs and what it may be. And that's not my vertical. I'm not an expert kind of on the biomed side, so I would refer you to someone else. But generally, what you see when you're looking for public companies as kind of a target or as opportunities to work with, you'll find a lot of the biotech stocks where they had great kind of traction initially, but something didn't work out, whatever it may be. It didn't get approval, didn't get drugs passed, from FDA. I'm not even sure what all that could entail, but something didn't work out, and then you get that price deterioration over time.
Thank you so much.
Yeah, absolutely.
Very nice. Maybe one question that would be interesting to get an answer for is, especially given your background as somebody who has been very active on chain, who has had crypto hedge funds in the past, what makes the DAT structure favorable to just launch, let's say, a vault on Upshift or any of the vault providers and do it from an on-chain first perspective? Because from the surface, it looks like raising a DAT, you have much more legal requirements. You kind of have the existing company that can be either an asset or liability, depending on how well it's doing. But overall, it just seems to be a much more effortful and complex operation. Is it because the capital you can attract into a DAT is capital that you otherwise would not have been able to access on chain? Or like, what is the general thesis behind launching a DAT and taking on the entire takeover process of taking over such a existing company versus just launching something new?
Absolutely, and great question. I really like the correlation that you made with what's the difference between a DAT versus kind of an on-chain vault. Great question. I see those kind of very similarly, but with one kind of distinct advantage that DATs offer. One is they're, I guess, in the case of on-chain vaults, both of which are being operated by very specialized set of team members that know what they're doing. They've been in the space. They're used to handling institutional grade capital and churning a return and a yield on it. One of kind of the differences, though, is when you access the public markets, your access to liquidity and your rails and your infrastructure for liquidity is just immensely more open. And when you have a premium trading on the public company through its stock that's trades, previously the market has been ascribing a premium to all of the public DATs. And so you essentially could raise money at the valuation for the assets you have on the balance sheet plus a premium to the business. And then if you felt as though the assets you have on hand plus the premium of the business was still lower than what you thought the market was ascribing a premium to your stock price at, you could sell shares into the market in what we've seen, in some capacities, basically what the market could handle. So almost unlimited size to raise money for the company. And all of that money that you would have raised through the stock sales could be recycled back in to purchasing the digital assets that you wanted to purchase and growing your balance sheet from that perspective. And the premium has been incredibly strong with regards to DATs in the public market space. I think in crypto, you've seen kind of vaults that have that capacity. But what I think that the more direct kind of corollary would be if a vault traded in DeFi and it had a separate symbol that represented the enterprise value of that, and you had big institutions that already had the infrastructure and the rails to click one button and purchase it. And that token symbol that represented the enterprise value of that vault was trading at a much higher premium than the assets of that are even in the vault. So I think that's kind of a more direct corollary. And those are kind of the biggest kind of differences of how I see those two and kind of comparison.
Yeah, I think that makes a lot of sense.
For a debt company that you're consulting or you're to some extent kind of like spearheading beyond BNB and beyond kind of like what Binance has to offer, what on-chain product do you find interesting, or at what point would it be worth it for you or interesting for you to deploy capital into solely on-chain products beyond kind of the safety of BNB and Binance?
Yeah, let me make sure I'm picking up what you're asking, right? You're asking what in what capacity would as an individual would you invest kind of directly into the DeFi market or as
As a debt.
So I think this kind of goes to the experience that I've kind of picked up through kind of the years of managing institutional grade solutions for on-chain deployment, kind of in DeFi, and some of which are more quant based that are more exchange trading. We have a risk framework that's internal and proprietary, where any opportunity that presents itself, we run through our risk framework, and that determines whether it's positive EV for us to take on that position, or if it makes sense to kind of either wait for that system, wait for that opportunity set to mature a little bit. There's too much risk associated. What are the oracles? I mean, there's just a bunch of questions that, as we've seen with DeFi, that make it such that that we would kind of pass on the opportunity. I think to the extent of where we are now, most of the DeFi opportunities, just with the risks that go along with it, are providing liquidity in established, decentralized swap markets, which at this point is essentially tried and true and kind of the blue chip is you have Uniswap, you have PancakeSwap, where there's never been a hack associated with providing liquidity in those particular pools and then managing it. It's more so been hacks associated with whatever you're pairing your asset with. So that level of scrutiny goes into kind of the on-chain activities, and then to kind of some of the other strategies, as I mentioned earlier, is launch pool, which is doesn't have exposure to DeFi itself. It is you're staking directly to the Binance exchange, and then just essentially getting an allocation of future tokens that can be sold from projects. And I'll speak to that a little bit more on kind of that's where we see the flywheel. We think that yield is sustainable and we think it grows with the growth of Binance because you get this continual effect of who's the best exchange from the mindset of a project. If you're having your token generation event and you want the best launch that you can do and perform the best for your investors, you're asking yourself, what is the best exchange I can go to and launch or have my token generation event? And number one unequivocally is Binance. So to go to Binance, you have to be the best and you have to talk with them. And it has that effect of the best go to the best. And as Binance continues to grow, the best products are going to continue to go there to launch their tokens. And it's like liquidity needs liquidity. That's going to be the flywheel that kicks off from that.
In terms of strategies you're able to execute and implement, do these likely change over time? And are there any restrictions that you can and cannot do with assets under a DAT, let's say, compared to if you would have just launched a vault? And maybe a follow-up question to what you explained a few minutes ago is, so is creating a premium to your net asset value like an explicitly stated goal of every DAT? And are there any common strategies how they are trying to achieve that?
There are definitely activities that on-chain vaults would or may not do, or kind of it depends on the kind of your risk threshold. And I think on-chain markets where they have the vaults, they have the market is selective of the vaults that are doing particular things. For example, Midas, which is kind of emerging as an extremely strong kind of um, entity in the space, they allow different vaults to kind of kick up underneath them, and each of them can do different strategies, some of which are MEV, some of which may be more kind of trade heavy, and some of them may be more undisclosed. Some of them may even take real world assets. And it allows the users to kind of pick and choose what exposures they want from allocating to each individual vault. And I think that sets it up, it lends itself well to the market of if the market wants it, there will be appetite and value will flow to it. And if the strategy for market participants deems it's too risky, they'll pull funds from it. And so I think that you get kind of that direct market feedback from a vault deployer and seeing how the market receives it versus based off their strategy. So to answer your question, I don't think they really have restrictions to the point of other than what the market demand is. For us operating as a public company, there are definitely restrictions and things that we can or can't do. And I think most of which are those protections are there for the betterment of investors. And so there's definitely guardrails for us. On to kind of some of the strategies that you mentioned or asked about for kind of ascribing to the valuation of the company. I think that's pretty common for what you're going to see in the DAT space. Most companies have a strategy of how they're, telling their story, sharing with what they're doing in the space. And from my personal perspective, I think it's all cumulative. I think it's all additive to the space, and it's better for everyone. Multiple DATs operating even on the same token is bullish for token price, for fundamentals, and for kind of the cousin and sister companies that are growing in the space together, because we're all accumulating the tokens. And if you're accumulating the same token, that's even more positive buy pressure. And that's more kind of sticks in the fire, so to speak, to kind of grow and get kind of Western adoption, at least from our perspective for BNB, which has the most room to grow kind of in the Western world. So.
Yeah, I think these were a ton of insights. Is there any other either like BNB treasury company related topics you'd like to cover? Any other thesis on the BNB ecosystem as a whole, or like any last touch points?
I think we covered it all pretty well. And again, I just kind of echo the sentiment that I think there's real growth in kind of the Binance ecosystem, and the fact that globally, everyone has access now to get a piece of that, so to speak, really lends itself well to that ecosystem and kind of the progress that decentralized finance has made just over the entire term of the past 5 to 7 years, just growing from initially starting as one swap pool on Uniswap where I can trade Ethereum for XYZ or whatever else. The industry has grown quite a bit. BNB has ingrained itself in deeply to the Binance ecosystem, and Binance has done an incredible job of tying the value proposition that Binance Exchange has into the token BNB, that they're interwoven so well. It's just a great opportunity to be in, and especially for everyone to have access to it now.
Very nice. Any last comments from your side, Onur?
I'm looking at the Nasdaq at which charts bottomed, trying to. No, just kidding. I know, super insightful. Very, very insightful. And I will say though, I did look into the process of buying stock to create a DAT in the past myself, because in order to get publicly listed with an existing company, the requirements are very high. 50 million revenue, certain valuations or whatnot. And hearing it firsthand from you, JR, was just incredibly valuable. So thanks again for that.
Thank you. It's a lot of conversations to do it, but hey, appreciate you guys for having me on. It was a great time to talk with you guys and kind of jump into these topics. I could talk about them all day and love doing it. So appreciate the time, guys.
Very nice. Thanks a lot for joining. And any touch points where people can find you on X, Telegram, website, or what's the best way to reach out?
Yeah, absolutely. Let me send them to you after, and then you can maybe throw them on the post, and then
Sure.
we can go
We'll
from there.
include them in the podcast description.
Perfect. Thanks, guys.
Nice. Thanks a lot, and see you later.
Take care. Bye, guys.
Bye.